Chetan, so 8% growth for India could be the norm from here.
Well, no, I think we are basically saying that India will still grow at 6.5 to 7%. But what we are arguing is that in terms of the dynamic or the characteristics of this cycle will be similar to what we had seen in 2003 to 7, where it was driven by investment to GDP going up higher. So, for example, in that cycle, what we'd seen is investment to GDP went up by about over 10 percentage points to 38% by 2007. And in this cycle, we have seen something similar. It troughed at 28% of GDP, and we're expecting this to go to 36% over the next 3 years. So that's the similarity that makes us feel that this is similar to that cycle. But the key important point is that if growth is driven by investment, then for an emerging market like India, you will not see the macro stability issues like high inflation or current account deficit. And therefore, it makes it easier for investors to sort of make an estimate of medium-term growth, which would be sustainable without going through some major challenges.
The question is, Chetan, what is a sustainable pace of growth for India in the long term? The likes of Raghuram Rajan have come out to say that India needs to grow more than 8% to create more jobs, to lift more people out of poverty.
Yeah, that's right. I mean, I wouldn't disagree with the fact that actually India does need higher growth rates, and we'd seen that China did achieve something like 10% for 30 years. So to manage the concerns on job market concerns, i.e. that, if your labor force is growing so strongly, then you need that kind of growth rate. But we do think that there are challenges for India to achieve, 8 to 10% growth rates. The biggest issue would be the infrastructure setup. Infrastructure is being built in India. But it'll have to do a lot more to get to 8 to 10% growth rate. And then the second challenge would be about skilled manpower. So both these constraints, we think, will makes us believe that India's growth is going to be strong, but at 6.5 to 7% rather than 8-10%.
People are beginning to talk about how India is an alternative to China. We're beginning to see that in the market already. In terms of the economy, I mean, what policies are needed to make India the choice destination for investors?
Well, I think, it will have its rightful place, and we are seeing that happening already in terms of the capital market inflows. And even when you see the FDI data, India's market share in global FDI has been going up. In fact, it is made the biggest delta in that market share after Japan within the region. And China has lost market share in global FDI. So that trend is coming in through. But to say that whether India can completely replace China or compete very heavily in the manufacturing sector, we think that's less likely because China is far more advanced, and as you see from the data, that China is getting into now new age industries like the renewable space as well as legacy chips. And India is going to take time to get to that type of competitiveness. So we think India will see a gain in its market share for global goods exports and FDI, but it would have to be still at its own merits rather than taking away market share in a big way from China.